Here we have the performance of the balance fund over time. You can see it over various time periods. You can look at it relative to the median fund manager and relative to the CPI plus 4 benchmark. And the fund has no doubt done well, but I think equally important is to focus on the stability of the fund over time. And if you look at this slide, what you can see is the volatility of our fund relative to the median fund, and you can see that the volatility is quite a little bit less. And that's really key for us. That's important to Truffle Asset Management because we do focus on downside protection, and that is hopefully being borne out here by this slide that looks at a period of 3 years. Moving on to what worked for us and what didn't work for us over the last year, you'll see diversified miners was a significant contributor to the performance of the fund, and really that is quite a bit of that is attributable to the performance of coal, which drove shares like Glencore and Thungela. We've taken some profits of those from those shares, given how well they have given how well they've done, and we've actually moved some of that into other diversified miners that'll benefit more from rising metal prices, which we can discuss a little bit later. Banks have also done well for us. We maintain a position in banks. SA banks are offering fantastic dividend yields. If you take the likes of a ABSA, it's offering a dividend yield in excess of 8%. So we still maintain a fairly sizable position in that sector. Currency also a big contributor, and that's no surprise just given how weak the rand has been over the year. If you look at the key detractor, it was obviously our holdings in foreign equity. So our holdings in foreign equity have been quite low. We've been worried about valuations, particularly of the US market, which is nearly 60% of global markets. So that talks to the low weighting. But if we look at the overall global market, that was down nearly 20%. So that obviously had a negative impact on us. We have hedged against the US market to quite an extent, and you can see that as a positive contributor from our derivative position. So with that, I'm going to move on to what I consider to be some of the key themes that investors should be focusing on over the next year, and we'll look at how these obviously translate into our portfolios. The China reopening is obviously very key, and that has an implication for the likes of commodities, emerging markets, and obviously South Africa fits in that basket. You've had very tight US monetary policy this year. We think that'll continue, just given where labor markets are, and that obviously has implications for US markets that we think are expensive, as I said earlier. And then finally, SA is really caught in the cross currents of a China reopening, which is good for emerging markets, as I said, but unfortunately we've scored some own goals that I'm sure everyone is well aware of. And then finally, if one looks at the valuations of the JSE, they are still fairly compelling, which is obviously also very, very key, given that is a key asset in the portfolio or key source of assets for the portfolio. So what we've seen this year is a rapid reopening of China. And that was quite surprising, just given how the 20th Party Congress ended towards the end of last year. It ended with a very negative speech, which certainly put quite a somber mood on Chinese markets that had underperformed quite dramatically over last year. But a lot of social unrest and pressure obviously forced government into opening up more quickly. So we've seen a lot of mobility in China improving, people spending a lot more, and we know they have substantial savings if we look at what their bank balances were pre-COVID. So that's certainly going to find its way into shares like Richemont, where nearly 30% of their spend comes from China. And we're obviously seeing an easing up in terms of property markets, where we are seeing credit requirements being eased up. And that's obviously good for commodity prices, which is good for the likes of our SA miners. So this is no doubt important for the positioning of particularly our miners in the SA portfolio, where we have actually increased our exposure to particularly the miners that have exposure to metals that are demanded from China. If you look here, you can see the credit impulse in China, which is the rate of change of credit in the country, and you can see that's been quite negative, but it's actually starting to move into positive territory. And this has historically been a good leading indicator of where we expect metal prices to go. So we expect them to increase, as you can see from this chart. Looking at the US markets, I think it's important to start with where real yields have been currently and where they've been historically. So we know that real yields, or the yields on inflation-linked bonds, have been very depressed over the last 10 years. And that's really been enabled by very low inflation and a lot of QE. And we saw that obviously change quite dramatically with the rapid rise of inflation post a lot of the stimulus that we had in the US economy. And obviously other factors like the war would have obviously made that even worse. But nonetheless, what we've seen as a result of that is a much more hawkish Fed, and we've finally seen real rates reach a level that's far more in keeping than what we would historically expect, which is really a rate somewhere close to GDP growth. And you can see here, if you look at the history at the first part of the chart, you can see a 1.8% is certainly where you would expect real rates to be, a level which is more in line with GDP growth. So given what we've had in the last 10 years, these very low rates obviously forced up equity valuations. Now that has changed, we think equity valuations actually need to come down a bit. So over the period where we had close to 0% real rates, or 0.4% to be specific, we had PE ratios trading at a level of about 17. With much higher real rates now, we think a PE ratio more in line with long-term history of, let's say, about 14 would be far more reasonable. So there's quite a bit of downside in the US market from current levels if we assume that real rates stay where they are. And we think real rates probably do stay where they are. There's going to be quite a lot of bond issuance from developed markets like the US, just given their high levels of debt and high spending requirements. If we look at the earnings base of the S&P, that's also fairly extended. If we look at where forecasts are, they are still quite a bit above trend. If we do go into a downturn, which is, I think, reasonably expected at this stage, we may well see some downgrades to those earnings, and that'll push up PE ratios even further. So that's an extra risk on the US economy, and really talks to why we have that hedge in place on the S&P 500. Finally, moving on to the SA economy. We obviously benefit hugely from China reopening. As I said earlier, that really pushes commodity demand. We have a lot of miners. Those higher commodity prices obviously translates into extra or additional profit for companies. That feeds into the fiscal balances. It also feeds into our trade account, which is good for the rand. It's good for our bonds. Unfortunately, against this, we have our own internal goals via load shedding, which obviously depresses consumer sentiment. It depresses business sentiment. And that is going to be negative for SA-focused companies. So what we do is we essentially add in an extra margin of safety when we look at investing in those businesses. Having said that, we certainly do find a lot of opportunities on the JSE still. If you look at our top 10 holdings, you'll certainly see some exposure to domestic companies like ABSA that I mentioned. So ABSA trading on a very generous dividend yield. But we have less exposure to a lot of the domestic companies than we would have had if we look back a year ago. We certainly still have a lot of exposure to miners, and we have exposure to some of the dual-listed companies like Richemont and Hauser. If you look at the overall equity weighting of the fund, it is moderate at 66%, and really we've reduced that a bit because we are worried about US markets where we've hedged at about 8.5% of the portfolio. Thank you. We do think that one of the major risks has been the US market. So we still think it is expensive, but it's certainly less expensive than it was. And as a result, we've actually cut back the extent of our hedge. And we've also seen some new opportunities. So certainly given the opening up of China, we are more positive on sectors that benefit from the likes of China. And that really speaks to shares like Richemont and many of the miners. I think there's a major change that we've had in the last few years, from the last 40 years, and that really talks to interest rates. So we've had a bull market in bonds for nearly 40 years, since the early 80s, and that's obviously not just been good for bond markets, that's been good for all asset classes, whether it's equity or whether it's property. That, I certainly think, has changed. We think from these levels, you're not going to see much downward move in interest rates to support other asset markets. And so I think a standard balance fund or a 60-40 fund is certainly going to be under a lot more pressure than it might have been historically. And I think that's going to require a lot more dynamism in terms of managing a balance fund portfolio. We still like to keep duration at a medium or in the belly of the curve. We think real yields at that duration are especially compelling given what's available in the rest of the world. So we still maintain our position there. We certainly think that in the short term, I spoke about earlier reopening of China, which is good for commodities. That obviously helps fiscal balances and trade balances. It's good for the rand. Should be good for bonds.